In terms of sustainable finance is that we kill the market before it's even really started. From a financier's perspective, from an investor's perspective, a number of them have got really strong regulatory drives, such as Solvency II, or else they've got fiduciary responsibilities as trustees of pension funds. And they can't be seen to be buying assets which cost them more to do the right thing for the environment. So I think our challenge is to be able to demonstrate that it's the right thing to do, and that from a cost perspective, whether it's for a company issuing finance or for an investor buying that debt, actually it's the right thing to do, and that they can justify why they're doing it. That for me as an issuer, I'm not spending any more in issuing a good piece of environmental finance, nor am I saving funds. And then from an investor's perspective, it's important that they're able to demonstrate that they've got good value and that their funds are being used to help improve the climate and to help mitigate the effects of climate change. I think if we're doing our job properly, I think some of the risks will be that we'll start to kind of crowd out the other bonds in the market, the other sort of forms of financing, and other forms of financing will start to then have greater premiums, and then it's a vicious circle. So for example, in talking to my chair of pension fund trustees, it was, well, why should we invest in assets that are not going to give us as much return as investing in other technologies or other areas, such as, take for example, tobacco. And our challenge is to demonstrate that you're not costing you more money, it's actually saving you money in the long term. That companies who are involved in sustainable finance or involved in doing the right thing from a social perspective are generating kind of much better long-term sustainable returns. So I think let's turn risks to opportunities.